I'm going to show you exactly why dividends don't matter, and for some people this might completely change the way you look at investing. So let me show you an example and we'll go through it step by step. Let's say we're going to invest in two different companies. We'll call it Company A and Company B. They both operate in the same industry, they sell the same kind of things, and the only difference is going to be that one pays a dividend and one pays none. Now we'll say that this Company A here is the one that pays the dividend and Company B does not. If we make the same investment in each company, let's say that 10 years ago or so, we bought $10 worth of shares in each company. Then both companies have done really well, and now our investments are worth $100 today. That's a 10x return, which I think we can all agree would be a very good investment either way. Now, one thing to say is that for Company A, the one that's been paying a dividend each year, we've made sure that we've reinvested every single dividend along the way to make this comparison fair. Company B, we've not had to do anything and we just left the investment to grow. At this stage, the investments are worth exactly the same, right? Both are worth $100. But what about the dividends? Well, what happened to them? Okay, well, let's get into the dividends to see what happens along the way. To keep things really simple, we'll say that Company A has managed to pay a dividend yield of 5% every year, and they just pay a single dividend each year. Remember that a dividend yield is the percentage paid to you when compared to the price of the share. So for year one, remember we bought $10 worth of stock, and a yield of 5% means that 5% of $10 is what we will receive as a dividend. So 5% of $10 is 50 cents, and at the end of the first year, here's what happened to our investment in Company A. On the day the dividend was paid out, your investing account would look like this. 50 cents of cash gets paid into your account, and then the value of your shares will drop by exactly the same amount. So you now have a stock worth $9.50 and 50 cents worth of cash. In total, you still have $10. Now this part is really important to understand, and this is what happens every time a stock pays a dividend. It's taking money from the company and giving it back to you as the shareholder. And just like how you might give someone money, once you give someone money, that means that you have less money and they have more. But in total, between you and that other person, you have the same amount. I hope that all makes sense. No new money gets created when a dividend gets paid. It's not magic, I'm afraid. Now here's the part where it does get a little complicated, so just bear with me. And it's also something that gets brought up by people who really like dividend stocks. If you reinvest your dividend and buy more shares of the exact same company, so in this example, you'd buy more shares of Company A with that 50-cent dividend, technically, you will end up owning more than one share of the company over time. Why? Well, remember that we said once a dividend's paid, the share price drops by the same amount. So what used to be a $10 stock is now a $9.50 stock. And what this means is that your 50-cent dividend, once reinvested, will actually end up giving you 1.05 shares of a company, or close to that number in this example. Now this is because 50 cents buys you just a tiny bit more of a share when a company costs $9.50 than when it costs $10, right? Nice and simple maths. So over many years, if you reinvest your dividends into Company A, you will probably end up owning more shares of the company as this effect compounds. And just to keep things simple, let's say that actually your single share of the company has ended up turning into 2 shares over the years. This effect is called a dividend snowball, and I did a video about this recently, and many investors love this idea as they end up owning more of a company and get paid more and more dividends. And for a lot of people, not everyone, they really like the idea that one day they could stop reinvesting their dividends and start using them to pay their bills and have a stream of passive income. Pretty much the dream scenario. But just step back for a second, remember what I said at the beginning. Both of these investments are worth $100 now. Company B hasn't paid a single dividend and is worth the same amount of money. So when you compare the performance of the investments, they look exactly the same, regardless of the payments of dividends. You've managed to 10x your investment from $10 to $100 in both companies, meaning that the total return is exactly the same. Now this part is really important to say again. The total return is exactly the same. Whether you get dividends and reinvest them, or whether the company keeps that cash invested inside the business, all that matters is total return, if you're an investor who wants to make the most money possible, which I hope you are. Now, another detail that gets brought up, sorry to get a little bit more technical again, but let's cover something that dividend investors will mention, and that is something called yield on cost. So we said that this company pays a 5% dividend yield, and 5% of $100 is $5. So this year, we'll be receiving dividends worth $5 from Company A. Now, that's a lot of dividends compared to our original investment in the company. Remember, that when we first invested, we only put $10 in. So $5 is now 50% worth of our original investment. Now that's how you calculate yield on cost. We take the dividend paid today and we compare it to the price that we originally paid for the stock. So $5 paid today divides into our original investment of $10 2 times, meaning that our yield on cost is 50%, which is amazing. This means that in just a single year, you're getting back half of your original investment. Now it all sounds great. In company A, we're gradually getting more shares and we're improving our yield on costs. I mean, what's not to like? This is pretty much the perfect storm if you're a dividend investor. Now, sorry to do this to you again. Zoom out and look at company B. No dividends have been paid, we've got no more shares, but we still have ended up in the exact same situation. Our investments are worth a total of $100. The total return is exactly the same, and that's all that matters if you're trying to make money, and hopefully that's why a lot of you out there are actually investing in the first place. It doesn't matter if company A suddenly pays out a huge amount in dividends, because all that happens is the price of the share drops by the amount of the dividend. You end up with cash and your shares, but now your shares are worth less. No money is created. So do dividends really matter at all? Well, they do, but not in the way that a lot of videos on YouTube make out, and not in the way that a lot of newer investors especially might think. You see, in the example I've just run through, it doesn't matter how much in dividends you get paid, as all that matters is total return. But we can't ignore them, they are part of the wider market. If we don't reinvest them and use them wisely, you can hurt your long-term returns. For example, let me just show you a chart here showing what happens in the stock market if you don't reinvest your dividends and you take them instead. $1,000 invested into the S&P 500 back in 1980 became $33,500 with no dividends being reinvested. If you invest your dividends from all of the companies in this index, your returns end up being a massive $93,000, so almost 3 times the number. Dividends definitely play a role here, but it's really important to realise where they came from in the first place, and that they're definitely not some kind of free cheat code to investors. Also, an important thing to note here is that looking at the S&P 500 at least, the dividend yield has been steadily declining over time as less companies are paying them and instead reinvesting the money for growth. If you only invest in companies that pay a dividend, a word of warning, you miss out on a huge part of the market. Now, what about when the market is bad? I hear this argument a lot, and dividend investors will say that during stock market crashes, they still get paid their dividends and they don't lose as much money as they would have done if they'd invested in something like growth stocks. But is this true? And again, does this matter? Let's just imagine we are in a recession, so pretty much all of the stock market's down. It won't matter whether it's big tech or old established companies, everything's going to be down. Now, what happens if you still get paid a dividend during this time? Well, this probably feels pretty good. Everyone else is out there suffering and you're still sat there getting your income. But again, does this matter, and are you really better off? Well, let's just speak generally for a moment. Companies that pay a dividend tend to be larger, they tend to be ones that are growing slowly, and many of them are in industries that hold up well during recessions. When you think of good examples like Coca-Cola, a famous dividend payer. Even when times are bad, many people are still going to buy that famous brown fizzy water, whether it's at home or out for some fast food on a Friday night. But remember what I showed at the beginning in the example with company A and B. Every time you get paid that dividend from Coca-Cola, the same thing happens. The stock price will fall by the amount of the dividends. No new money gets created, and all that's happening is money's moving from the company's bank account to your investing account. You haven't gained or lost anything, even if it might think and feel like you've got something. So mentally, it might feel nice to see a dividend coming into your account and even reinvesting it back into the company during a recession. But at the end of the day, all that matters are those total returns. And also, I was speaking generally here, there's no guarantee that dividends get paid, and there's also no guarantees that a stock price has to go up as well. You can't just say that one sector will definitely do well in a recession and another won't. There's no way of knowing the future, and anything that's known gets priced into the market. As another example, here's a popular stock, AT&T. This is a company with quite a high dividend yield in a very boring sector, and it's a very slow growing company. It was increasing dividends every year from 2003 to 2020, and the high yield attracted lots of dividend investors who thought that they might want to invest in a company like this. The problem is this though, have a look at 2 things. Firstly, the return of the stock price, let's just use the last 5 years as an example, down about 55%. Now, don't forget about total returns. What happens if we include all the dividend payments? Now that number changes to just down 18%. Still not great, And just for reference, how's the S&P 500 done during that time in total returns? 68% positive. And sure, before anyone has a go at me in the comments section, I know this is a poor example because you'll tell me that you only invest in good companies that increase their dividend and have a realistic yield, because you should never just look at a company with a dividend yield and invest in it. There are examples where companies pay a dividend and grow their share price at the same time, giving you a nice total return. Well, of course there is, and we can all cherry pick until the cows come home. But then my question back to you will always be, well, how do you know which companies will be around and grow for the next 20 years? If you have an answer for that, please can you also let me know the lottery numbers for the next week's Euro Millions? Now, as I went into my last video about the dividend snowball, did you know that out of all of the tens of thousands of stocks in the US, Canada and Europe, how many companies actually matched or beat the returns of the S&P 500 over the last 10 years? That's the total returns. And how many of those happen to be dividend stocks with a yield of 2% or more? The answer is less than 3% of all companies. Personally, if I was an investor who focused heavily on dividend stocks, I'd look myself in the mirror and ask myself if I was somehow special enough to be able to find the magical 3% of stocks that are actually worth owning. And then I'd ask myself the second question, why am I not owning an index fund? But more on that later, as there has to be a bit more we're missing about dividends that means they actually matter. Otherwise, surely there's just no point in them at all. Well, two things spring to mind. Firstly, if we go back to business basics, we would expect any money in a company used in the most efficient ways. This means that a business should be trying to make as much profit as possible in the most efficient way by hopefully using the resources that it has effectively. Now, I know that's a mouthful, but what I'm really trying to say here is that if a company generates excess cash that it can't use effectively, it is only right that it gets returned to the shareholders in the form of a dividend. So, for example, it's much better for a big company to pay out a dividend than have a huge amount of cash sat in a bank account earning very little interest, because that is not an efficient way of using money. Also, as the shareholders are the ultimate owners of the business and therefore owners of that cash, if the business pays out a dividend, it lets the shareholders decide what they want to do with that money themselves. It makes total sense, and that way some people might reinvest the money themselves in the same company, some might choose to invest in something else, and others might go and spend the money on themselves. That's an efficient way for money to flow. I know a little technical as an explanation, so sorry about that. But it does make sense that money shouldn't always sit with a business, especially if it can't come up with a good use for it. Then secondly, they might be useful for tax purposes. So this is something that I learned recently from a comment, and I forget exactly which country the person was based in, but he was telling me that dividends are taxed at a lower rate than capital gains. Now, it might have been Germany, I'm pretty sure it was a European one. And that was a really interesting point, because I was suggesting that investing in stocks just to get dividends is not a reliable way to get income. And that if you need to get money out of your investments, you should just sell what you need and not be reliant on when a company does or doesn't decide to pay you. However, depending on your tax situation and what kinds of tax advantage accounts that you can use as an investor, this might be something worth considering. But the comment also did say that they realised that by only investing in dividend-focused companies, that they will probably not beat the returns of a simple index fund, which invest in something like the S&P 500 or the world as a whole. And the tax rate wasn't so different from dividends to capital gains. It was really just a slight difference. So really, it's a tough call on that front. Just another reminder that we really need to think about how we invest as well as what we invest in if we want to be successful, because not every country is going to have the same rules. On that point, remember that I'm not a financial advisor, so please do seek out help if you need it. I'm just sharing my own views and thoughts. But on my own thoughts, if you are looking for a solution to try and get some passive income or have this idea of cash flow from investing, then I really think the majority of people are much better off just investing into the whole stock market using low-cost index funds in the most efficient investing account that they can have access to. If you then need cash or an income, you can sell part of what you need or just take a small dividend of what the index fund would pay anyway. And on that final note, is there a solution and are dividends really just a big distraction for investors? Mostly, I'd say yes, and I do worry that newer investors especially get fed a lie that they can somehow create a passive income by investing in dividend stocks. And while it might be nice to see money going into your investing account, in the end, all that matters are total returns, as I showed in the example at the beginning. If you disagree with this and you say that you're happy to invest knowing that you'll underperform even the simple returns of an index fund, then I really don't know what to tell you. This to me is like saying that you're happy driving a 3-wheel car in a race against everyone else using 4 wheels because you like the way it feels around a corner, even though it's more dangerous and you never get close to winning. If that's your rationale, then you do you. So sorry if this is hard for some people to hear, but dividends don't matter and you might end up costing yourself returns in the long run. And on that note, if you found this video interesting and you're wondering how you might be able to pick the right investments for you, here's a video where I share an important lesson as to why I no longer waste time trying to find the right stocks. I'll see you in the next video. Happy investing.